Good morning and welcome to the CT Property Trust Limited investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Christine Cantrell, Head of Investment Trust Sales. Good morning to you.
Good morning, everybody, and thanks for joining us. I just want to quickly remind people that CT Property Trust, up until a few months ago, was called BMO Real Estate Investments. And since the BMO Global Asset Management EMEA business got acquired by Columbia Threadneedle Investments parent company not so long ago, we've redone the name and the rebranding, etc. And it actually ties in very nicely with now Matthew Howard, the lead fund manager who has taken over as of July. So it's a nice fresh start, and I want to remind everyone, Columbia Threadneedle Investments is a large player in especially the UK asset management industry. Now we're top 10 in terms of assets under management, and we're very lucky to have Matthew running this fund. He had joined previously BMO in 2017 and has a long and strong track record of performance running some other funds, one of which he won an award for in 2020 for the previous 3 years performance. So hopefully I've covered just the introduction there, and I'll hand over to Matthew now to take you through some slides, and we'd love to have your questions then afterwards so we can concentrate on listening to you and taking your feedback as well.
Wonderful. Thank you, Christine, and good morning, everyone, and thank you for joining me today. Always a privilege to be able to talk about the fund. As Christine says, I think the session has been put in for 45 minutes or an hour. I don't plan on speaking for much longer than about half an hour on the fund at absolute top, so I'll try and stick to that, and obviously want to leave a reasonable amount of time for Q&A at the end. So when I was asked to submit the presentation, I was asked to put a slide summarizing what the fund is about as a kind of introductory slide, because I appreciate for the audience today there may be varying degrees of familiarity with the fund. I have done that, but before I did that, what I thought I would do is go straight into, and hopefully the slides are moving, we can skip past that. Christine introduced me. What I thought I'd do is go straight into broadly what's in the portfolio, because obviously we are a real estate investment trust. We invest in properties. I could steam right in and talk about the strategy and what we do, but I thought I'd give you a very brief overview of the types of assets that we hold, and some of these assets we'll talk in a bit more detail about today. So obviously we're a diversified trust. Now we do have a unique strategy, which I believe and we believe sets us apart from our competitors. But this is a broad overview of the assets that we hold. We do have geographic diversity, albeit we do have a bias to London and the Southeast, which is about 83.5% by value. Some of the assets, if you look at the industrial properties, the yellow dots, they're obviously weighted towards the Southeast, and some of those assets are the higher value properties in the fund. So the weighting by value is skewed more towards London and the Southeast, as I say, but we do have that benefit of diversity across all sectors, with offices across the UK, some small selective high street retail, and of course retail warehousing as well, which represents about 19% of the fund, and is about double of what the MSCI index shows at the minute for the global investable UK universe. So the second slide really just summarizes what I just said in terms of the weighting towards industrial and the retail warehouse space. These are the weightings as of June. Some of you will know that we did sell a prime West End building at 14 Berkeley Street for a little over 30 million, which completed in August, and that changes our weighting slightly. So industrial now is up to closer to 60%, retail warehousing closer to 20%, and offices have dropped to about 15%, but broadly we're keeping the bias within the fund. And again, in terms of what we're going to do going forward, I can talk to you about strategy and how we see those weightings adjusting over time. So this is the slide that was asked to put together, which is why the CT Commercial Property Trust. It's what was highlighted here really are the 4 to 5 distinctive features of the fund. Now, none of these features in isolation are unique to the fund. There's other funds within our peer group, but when you put them together, that's what creates the unique proposition of CT Property Trust. So what are we about? So we have what we call a focused sector allocation with diversity. I've already spoken to that. We take a bias position, a tilt towards where we see the growth sectors are, and we see that in the industrial space and retail warehousing. It's not something that we've done in necessarily the last 1 or 2 years. This is something that we've been working to over a longer period. The fund in earlier years was tilted towards high streets and industrial, and that sector performed very well for the fund, but over time moved away from that sector and over into industrial and retail warehousing. Now, we have made acquisitions in that space over the last year, but again, it's something which is more of a long-term tilt, and of course we're a long-term investor, which is obviously an advantage in commercial property. We have investment agility. Essentially, we're in the more liquid part of UK commercial property. Now, real estate is not a liquid asset class in isolation, but in terms of the lot sizes, that is the liquid point. Essentially, it's where you've got far more breadth of opportunities if you're looking to invest, because you can find assets to meet your strategy in a wider breadth of locations. But also it works on the other way. If you're ever selling a property, if you're in that kind of 7 to 15 million category or even slightly less, you're going to have a greater depth of demand in terms of buyers. And therefore, even when the markets are in more challenged stages, you've got more opportunity to exit and find a buyer. So, if you're looking at a property of, say, 10 million, it might be suited to far more locations than if you're looking to buy a property at, say, 30 or 40 million. So that's what we mean by investment agility. The fund also has attractive income. It has a superior income return from a portfolio level over the long term, and has outperformed the index by 82 basis points since inception, which is strong. The income is not as strong as it has been in recent years. It doesn't stand out as much as it used to, and that's partly to do with the victim of our own success, really, with the compression in yields for our industrial assets and the capital growth we've got through those assets. But I think because of the tilt towards industrial and the strength and the bias that we have there also geographically in London and the Southeast, then that does present the opportunity to rotate some of that portfolio and increase the yields with a bit more geographic diversity in the fund. So that's going to be part of our strategy, and I'll come on to that again shortly. And we've got here resilient locations. Now, obviously, when you're underwriting property, you look at the quality of the real estate, you look at the quality of the covenant, take the lease into account as well. But fundamentally, we look at the locations. There is a tendency in some quarters of the market to buy the lease, as it were. But we look at the underwrite when we're acquiring properties, look at what the land values are, look at the vacant possession value should the tenant leave. Look at the alternate uses and feasibility as whether the site could work as a residential site or for alternate commercial uses, should that be an option in the future. And that has always served us well. That's part of our investment philosophy at CT. It's something that the fund managers, Peter Lowe and Ian McBride before Peter, have always been part of their investment DNA, and it's part of my investment DNA. Christine mentioned a second ago about the RSA fund. It's a similar size fund, similar sized assets, and has always been part of my investment philosophy to do the underwrite as well as the look at the other factors in terms of suitable acquisitions. And I mentioned here as well a fully integrated ESG strategy. Now, this is not unique. ESG is not a side note and a nice to have for commercial property funds. It's fully integrated, and what we mean by that, it's there are touch points throughout the whole life cycle of property, whether you're profiling for something to buy, whether it's got strong ESG credentials on the spot, or you're costing in the upgrades if it's more of a core plus or value add acquisition. Also in terms of collecting data, running the property more, driving the environmental performance. but there's also an element of the social as well. Now, ESG, we could have a whole session or two discussing what ESG in real estate really means. But I think one of the things I'd like to draw out is the social side, and the social side could really encapsulate the agenda of the occupiers. So that could be as simple as, when you look at a building, does it suit occupiers' agenda? I.e., if it's an industrial building, does it have outside space for the site staff to be able to go outside in their breaks, which is more than just a smoker's corner? Or does it have a decent office provision so they can put in breakout areas for the staff, which goes beyond a small canteen with a microwave? So it's about the quality of experience for the occupiers, and that's something which is sometimes overlooked with ESG. We tend to focus on the governance part, but also the environmental performance, which is of course absolutely fundamental. But it goes way beyond that, and that's just an example of what a fully integrated ESG strategy is. And I'll make some further comments about our strategy further in the presentation. So all of that combined has served the business well, served the company well, and we do maintain outperformance against the MSCI index to get over all time series. And to illustrate that, the 1 year return up to June was 27.4% against the index of 19.1, and the 5 year annualized return 9.7 against the index of 6.9. Okay, so I'm looking to move the slides on, but it appears to there we go. Slight tech problem, right? Okay, and quite a busy slide, but just to draw out a couple of the attributes here. As I mentioned, if you look at the central column and the portfolio, mentioned liquid lot sizes. As we go down, void rate of 2.6% by ERV. Not saying that will maintain exactly that level in the long term, but I think that speaks to the quality of the portfolio and the tenant base, particularly after the last few years. And we've got a good average lease term to breaks, which is 6.1 years, which is 7 years to expiries. And rent collection as well. Not as big a topic as it was, but certainly going back to 2020, it was one of the headlines whenever you talked about a commercial fund. And the average rent collections since the start of the pandemic, the 27-month period to the end of June, 98% over that period, which is about as good as it gets for a diversified commercial fund with a reasonable weighting to retail through our warehouses. And we're back to normal levels now, 99.8% for the last quarter. But again, I think that speaks to the overall performance. Some of the performance matrix on the right-hand side show the portfolio performance in the top right box. The NAV performance at the end of June has been strong as well, a little above the property performance, so 34.3% over the 12 months. And share price performance to the end of June was 24. Obviously, share price has moved around a bit since the period from June, but overall has shown some recovery since the depths of the pandemic, but now obviously face a different cyclical challenge going forward. The one other thing I'd mention at this stage on this page, in the company snapshot on the bottom left corner, is our debt position. We have net gearing of 22.1%. Weighted cost of 3.2. The net gearing will reduce. Again, commented on the sale of the property in Berkeley Street in London, and we do have some cash to play with, which we're using in a number of different ways, and we'll be using that to pay off £7 million drawdown of the rolling credit facility. We've got a credit facility of about 20 million, undrawn 13, but we'll be paying that off. Part of that is pegged to Sonia, so be a good time to pay that off. So in the process of doing that. Okay, and then to cap off a little bit about the performance, I've kind of said this already, but the blue boxes are the trust, and the grey boxes are the index, and you can see the outperformance over 1 year, 3 year, and 5 years. So I won't linger too long on that slide. And again, to illustrate the point about income return, really the dark blue line, that is CTPT, and that is the income return over the index over the last 10 years, just to illustrate that point there. And final comment on performance is the risk-adjusted returns. And you can see we've got a lower standard deviation, a lower volatility than the benchmark, but is generating higher returns. So part of the driver as to why CT Property Trust has outperform the market over all time series. Okay, so we'll get a little bit into the portfolio overall. Obviously, I provided the map and I showed you the weightings in terms of the sectors that we hold. So I'll give you a bit more detail about the composition of the fund, and also in terms of what we've been up to recently. And as I say, then I'll come on to strategy. I'll also provide a bit of an update on the market. Now, normally these presentations, they start with that market piece, but I thought it'd be quite important to start with what the fund's about really, but we can talk about the market at the end, and I think that's the final section before we move seamlessly into the Q&A. So I've lingered on this slide. Really, this just illustrates the top 10 holdings in terms of value, and you've got the percentage weightings there. And really, what this speaks to is, as I said earlier, some of the industrial assets are at the higher end versus the average value in the fund, but still holding quite a good diversity with a little under 60% in the top 10 assets. And there's about 35 assets in the fund overall. Okay, and good diversity with the tenant concentration as well. I won't go through all of these, but the high level comment is in our offices portfolio, we do have a pretty strong tenant base. We've got Lloyds Bank, HSBC, Secretary of State. So we have quite a strong covenant base when it comes to our offices. And then in the industrial space, it's pretty broad, but quite a lot of logistics operators. And what I'd comment on also is retail warehousing. Now, the retail warehouse sector has had a fantastic run in terms of values and has seen some rental growth, and it really has rebounded from the depths and the challenges that it went through. If you go back to, say, the start of 2018, when you had a run of CVAs and administrations in that point, there was really a restructuring in that market. But what we focused on in terms of investment is what I like to call the essential retail end of the market. So away from the fashion-led, away from occupiers which are rely on a lot of discretionary spend and leisure, for example. But these are the kind of day-to-day occupiers like DIY, discount retailers, pet stores, for example. And a lot of the parks within the fund, and this plays into the point about investment agility. A lot of these parks are valued around the 10 million mark, give or take, and they're off rents between £10 to £15 per square foot in very sustainable locations. So when they're 1, 2, 3 unit schemes, they serve their markets well. They're in core spots for the local markets. They're near good transport interchanges and got good infrastructure, and they might go below the radar compared to some of the, say, bigger parks, like if you say something like Cripps Causeway or Leicester Fosse, big parks that might be on M1 junctions or motorway junctions that people know about. But I think with the bigger parks, they've got more challenges. They do have more units to let, so you're competing against yourself. There's always some void to address, and also they're trying to maintain higher rents. Typically £25 per square foot plus, if not higher. Whereas these schemes, they never get ahead of themselves in terms of their rent per square foot. They're pretty sustainable. We've got other occupiers knocking on our door in terms of if a unit ever came back, and we've got 100% occupancy in our retail warehouse portfolio at the moment. So as that represents broadly 20% of the fund, I think that speaks to the quality and the sustainability of the locations and the retail warehouse assets that we hold. Okay, so jumping back to ESG, I mean, as I say, we could have a whole session on ESG, and something which I feel quite passionately about is that we don't bombard with acronyms and jumping in to the depths without putting it into some context. Now, I don't want to get sidetracked on the topic today because, again, it is something you need to do in depth and not whiz over. But in order to give you some high-level messages in terms of the independent verification of our credentials, GRESB, which is essentially, it's like the equivalent of MSCI, but for ESG, we scored 70 points last year and got 2 green stars. So that's pretty strong against our peer group. And that really is scoring us against our governance, our environmental performance, and also the social elements. And we have got other accreditations as well in terms of our reporting and disclosure. We've got a gold award from EPRA, which is more of a European-wide sustainability body. And in terms of the energy performance, we are on the right trajectory. We've got 100% of landlord procured electricity supplies from green tariffs, recycling. 99% of our waste is averted from landfill. So we're moving things forward. What I'd like to say in terms of the headline is net zero carbon. Now, that is something which people on the call might know varying degrees about, but you'll see that within our peer group and within the wider real estate universe, people are announcing their net zero carbon target date. So what dates are these funds going to get to net zero carbon? Now, we took a decision, the board took a decision at the end of beginning of 2022 that we wanted to announce our date with a little bit more information behind that and a bit more credibility, i.e. that we would conduct net zero carbon assessments on every property before announcing the date. So we had more information behind that. That's a big undertaking. There's a challenge in terms of capacity in the market in finding the availability of those that do these surveys, because it's still relatively early days in this environment. But we managed to do that over the summer. We're now in the process of going through all of that information with the asset managers, with our sustainability team, and we're on course to announce our net zero carbon target year by the end of this calendar year, but having done all those surveys. So it's something which has gone down well with our shareholders. We believe it's the right way round of doing things, and we'll have more news on that very shortly. I don't need to linger on this slide really. This comments on rent collection since the start of the pandemic and why we believe we've sustained such a strong level while also being sensitive to occupier needs during the pandemic. So I won't linger here. And that moves us on to portfolio activity. So here there are quite a few busy slides, and don't trouble yourself reading all the text. But what I wanted to give you is a bit of an overview in terms of some of the value adds work we've done in terms of the active asset management, as it's called. Also some of the transactions, what we've acquired in recent times and what we've sold, and also some of the more regular day-to-day asset management and what we're seeing with our tenants. And I think that will summarize the activity in the fund. And it will also speak to the strategy of the fund and the ethos and what it's about. And then we'll move on to the market overall and Q&A. So these are two relatively sizable refurbishments, one in Luton on the left-hand side. So this was a Solus retail warehouse, Solus as in single occupier, let to Homebase. And you'll recall they had a CVA about 4 years ago, 2018. And the CVA gave us a right to serve notice to Homebase, and we engaged with them. They actually traded very well from the location. The reason for their CVA was more of a corporate challenge. And because of the strength of the location, going back to that point on location, we managed to attract Aldi, the discount food store, to take part of that site, and also Costa to take a pod, as it's called, for a small Costa drive-through. So invested just over 4 million on that project, and the valuation post works showed development profit of 3.5 million. So a significant driver of performance for the fund. And then on the right hand side, you've got an office, County House in Chelmsford, probably the best office building in the prime location within a regional office location like Chelmsford. And again, it's quite a big refurbishment that the guys took on, just over 5 million capital expenditure. And there was pre-letting to over 50% to the Secretary of State for Housing, and generated with the valuation on PC of a development profit of 1.2. So again, not all value add work will absolutely knock it out the park in terms of returns. It's not quite as out there as Luton, but again, still solid returns and calculated risk-adjusted returns that we expect from value adds. This was another driver and demonstrates the capacity within the team. Purchases. So about this time last year, the guys bought 2 assets. One was a property in Heathrow, which adjoins an existing holding, single let to DAF, who run commercial trucks. And on the right-hand side, this was a retail warehouse, 2-unit retail warehouse scheme, again within keeping within that kind of that category of retail warehousing that I was talking about. Again, that was acquired, and the reason that the timing, and both of these were bought around the same time, and that's because that's where the team sought value, and that's our investment approach, really. You know, we don't we're a closed-ended structure. Obviously, we do hold cash on the fund, and that does present a certain degree of pressure with allocating that cash, but we back ourselves with investors. You know, we're all fully immersed in the UK commercial markets. You know, we have a lot of contacts. We source off-market opportunities. Both of these opportunities were off-market, and the values have moved on since acquiring. I think the combined value of these two were a little over 90 million when we bought them. They were the purchase price. And as of June, just over 26 million combined valuation. Now, obviously, moving forward, values are under pressure, and we'll talk about that certainly in the Q&A. But good performance driven by acquiring at the right time and not necessarily just buying the market. So this is the headline grabber for us over the summer. I've mentioned this already, 14 Berkeley Street in London, and really the idea of the sale here was a couple of drivers. First of all, it was at its peak in its asset management cycle. So the team had undertaken a rolling refurbishment of this property. I mean, all the floors are let to separate tenants. You know, it's in the heart of Mayfair. A lot of wealth management, asset management type businesses. It works very well for the location. So as and when floors came back, we put some capital expenditure into it and relet it at rents which were higher than before. So good premium to passing rent. And we saw an opportunity in the early part of the year to sell at a decent price. There's a real strong demand for prime offices, particularly from overseas in London. And we brought it to market just in time, I would say, until some of the slowing, albeit we've seen the prime end of London offices are still, it's quite a lot of demand still for investors with a long-term horizon. And the property, you know, for those familiar with the fund will probably know it well. You see it often on the cover of the annual report and accounts. It photographs well, people understand it. It's probably the most prime located. But in terms of its overall total returns, you know, it hasn't knocked it out the park, as it were. It's a relatively lower returning property for the building. You know, it's valued at quite a keen yield, and the board and former fund manager saw an opportunity to enhance the income return of the portfolio by exiting some of these lower yielding properties at the right point in their asset cycle, and that was very much the decision taken for 14 Berkeley Street, and pleased to say that it was successfully delivered in July. And we've got here focus on resilience. So really a couple of slides here that summarize some of the asset management activity, and I won't go into all the detail involving these, but it's just, this is what we see on a day-to-day. You know, these are the conversations that we have with our occupiers. And again, not quite headline grabbing. If we submitted these to Property Week, they wouldn't put them high on the webpage or even near the front of the magazine. But it's about the day-to-day management of these schemes and about sustainability of income. Berkeley Street, I've already talked about. On the top right, we've got retail parking in Bury, and again, Benson's for beds. We re-geared that lease. We signed a new 10-year term in Q2 of this year, as they're very pleased with the unit. New Malden, Beverley Way, we re-geared 2 5-year terms to Tappy Carpets and Halfords recently at a premium to ERV. An industrial unit in the bottom right corner. This is a late 90s build, so not a brand new modern facility, but the outgoing occupier had served notice, and we had virtually zero void here because we managed to, before the expiry of the existing void, we managed to sign up a new tenant in IT, and we captured an uplift of 33% above the previous passing rent. Now, that was no surprise because we saw that in the ERVs for the unit. We knew what was happening to ERVs in the area. But again, you know, actions speak louder than words, and that's what we were able to deliver on that property. And a few more examples. I commented about the average lot size in the funds, about 11.7 million. It's about 11.2 after the sale of Berkeley Street. And we've got some bigger assets in the industrial end, which are in the kind of late teens into the 20s. But we do have a relatively long tail of smaller assets, particularly our high street holdings. Again, if you go back to that map, you might look at that and say you've got quite a lot of high street in there, but it only represents about 5% of the funds by value. And the property in Sunningdale, this is a relatively low profile unit, but all the commercial units on the ground floor are fully let, and we're in a process of renewing those. Great footfall, really cool location for its local area. And I think it's a good point to comment on high street, really. Retail has been under a lot of challenge in the last few years, and we're not necessarily through that. But there is a place for high streets, strong suburbs, local areas. If you look at a lot of towns and cities, the high street will survive. It just needs to be smaller. So some of the units that we have in our portfolio, they're focused on those parts of the high street where if you were to reduce the high street to its appropriate level, or pick the point where you've got great footfall still on a day-to-day, if you go and visit it at 11 o'clock on a Wednesday morning, will it have people in circulation? Absolutely. And that's the property in Sunningdale is a good example of that. The retail park in Bromsgrove in the top right, again, we have Homebase there, which still trade from the store. They trade very well. And when they went through their CVA a couple of years ago, there was a discount food store who were very keen on taking that unit should Homebase exit. And what we did is we actually put what's called an insurance lease in place, which was a outline of a lease which was executed, and if they ever left, it would trigger the lease, and the food store would take the unit. So again, it speaks to that underlying demand for these retail parks, which, as I say, are lower profile from some of the big multi-let parks that you may know and use. And I won't talk about the last two examples. I think I've made the point, but again, these are just examples in terms of regears and tenants remaining in our portfolio, which again supports the low low void of 2.6%. I commented earlier about our bias, our tilts towards certain growth sectors. So over the last 5 to 10 years, the fund managers have gradually sold down some of our high street units, which we'd seen performance from, but didn't back on a long-term basis. And what you see here is a selection of the 14 high street assets which have been sold since 2016. So example of some of the activity there. And the reason why we've done that over a long period, because again, it's about picking the right point in the cycle. Obviously, high street is not as strong as it was 10 years ago, but again, there is still some strategy in terms of the timing of these sales, which is important when you're a close-ended investment trust. So final slide, really, before I move on to a few comments on the market, is about how we see things going forward. I'd like to draw your attention back to that slide right at the start, with the bubbles in terms of what the ethos, what CT Property Trust is about. And as I said, it's about a focus sector allocation. It's about investment agility and the lot sizes. It's about attractive income and beating the index in terms of its income return. And it's about resilience, resilient locations and looking at the underwrite. And I'll read out the quote on the left-hand side, which summarizes the strategy, which is: the company's strategy will be to utilize the significant opportunities and strengths within the fund and refocus the long-term philosophy of investment agility and resilient locations to enhance income and capital returns. Sounds very nice. Could say it's a little bit wordy, but what does it actually mean? Basically, I think the fund is in a really good state. It's an excellent portfolio. It's not perfect, and it doesn't mean that there's passive management. We just sit there and collect the checks. With a real estate portfolio, there's always work to do. But the opportunity within the fund is really to do with the weightings that we have. Now, let me explain that in a bit more detail. I'm very supportive of a bias towards London and the Southeast, and I'm very supportive of the bias towards industrial and retail warehousing. And just to remind you, the industrial weighting is almost 55% as of June, and retail warehousing about 19%. And the bias to London and the southeast, again to repeat, is just shy of 84%. Now, long term, I think we should maintain the overweighting in those geographies and those sectors. But that weighting, particularly on the geographic side, is quite high. So that gives us quite a lot of flexibility to rotate some of the portfolio where we can still maintain a bias, but add some more diversity for the fund. Now, if I remind you of that map that I put up at the start of the presentation, all of the industrial holdings are essentially in the southeast. And if you know much about industrial valuations at the moment, you'll know that those yields are pretty much in the threes on an initial yield basis for all those assets, some of which in twos. Now, that's they're there for a reason. The reversionary potential of the industrial portfolio. And if you look at the estimated rental value assessed by our valuer, so this is an independent estimated rental value, and you compare that to the passing rent today, there is broadly about a 30% reversion. So what that's saying is, if we waited for all the lease events to occur and didn't expect any further rental growth, just said rental growth will be flat for the next 5 years. That's not what I'm saying, but if you assumed that, there's almost 30% reversion to come through, which is great because you have a number of years, you wait for lease events to occur, and then you just see that rent gradually growing. But I think there's an opportunity to essentially short circuit some of that income growth, i.e. At the right point in the market. And I appreciate we're in a period of economic headwinds, to put it lightly, but in the relative short to medium term, there will be an opportunity to exit some of those, let's say the industrial assets, which are lower yielding, and reinvest maybe into industrial, potentially into retail warehousing, but add a bit more geographic diversity. And I'll oversimplify an example, but if you had an industrial asset of say 30 million with an initial yield income return of 3.5%, it would be to sell that and buy say 2 or 3 industrial assets, or maybe a retail warehouse in there at closer to say 4.5%. And the reason we can do that is with geographic diversity. And as I say, with the philosophy of the fund, with the ethos of the fund in terms of sustainable locations, the investment agility, the ability to be quite entrepreneurial in terms of where we invest, locations that might be a little bit more under the radar. Places like the Northwest would fit that absolute, right on the nose in terms of our strategy. But if you look at our weightings, we have say 3.1% against the Northwest. So it's one of the main economic centres of the UK. Fantastic infrastructure up there, strong population and population density. There'll be plenty of opportunities for us to increase the income return of the portfolio with some strategic rotation of some of the assets, and that's an example of what we'll be looking to do. And as I say, add some diversity with the capital growth of some of the assets. They've moved away from our average lot size, which is, as I say, 11 million. Target lot sizes are 7 to 15. But some of these assets, which aren't uncomfortably large in the fund, but larger than we would target. So again, we can recycle out of some of those properties into geographically diverse, slightly smaller properties in line with our targets, and add some income return, but without compromising on strength of location, strength of covenant, or quality of real estate. So I think that's key. And the final point I would say in terms of the property strategy would be target sectors. I think, as I've said already, we'd be happy to reinvest in industrial. I think retail warehousing is still a very interesting sector, and there's some long-term growth and prospects there. We'd be quite cautious in terms of offices, and I'm sure that'll come up in the Q&A. The office market is not dead by any means, but probably less of an area of focus. And I think one other area that we should keep an eye on, albeit it's not essential, is some of the long income opportunities within the alternative space. Now, alternatives is an area which you have to err on the side of caution, i.e. it's not a sideshow to the traditional main commercial sectors. Alternatives, i.e. hotels, student accommodation, car parks, that accounts for about 25 to 30% of all commercial transactions of the last 5 years, and it's about 20% of the benchmark. So it's quite a big deal. The majority of that is student accommodation and hotels. But what I'd like to stress when I say alternatives is that we would not be taking on direct operational risk. We don't have the scale in this fund to take on larger assets that have that economies of scale where your costs, there's less volatility in your costs. So if we see mispricing, we see attractive long-term values in a hotel, for example, with long income, with indexation, then we should consider that. So it's part of the overall investment strategy of the fund. If we don't see that and we don't invest in that space, it's not a problem. The fund hasn't before, and it hasn't hurt the fund. So, but it's just something that we'd consider as we go forward. The last 3 points there: active asset management. Well, that's the day-to-day management. That's the credentials of our platform. What we've always done. I've already commented on ESG and net zero carbon, and then there's the point on corporate. Obviously, we hold some more cash than we typically would long term at the moment. We've got a program of share buybacks, and we've got other ideas in terms of what we might do with that cash, which again I'm sure we'll talk about in the Q&A. Okay, and then to wrap up the section before we move on to the Q&A is just a few comments on property performance overall. I've already discussed the fact that the MSCI index delivered on a direct basis 19.3%, and you'll see the second bar, the light blue bar, listed real estate has lagged. And there's various reasons for that, but if you move to the right hand side, you look over 10 years, the two performance between real estate equities and direct real estate are far more closely aligned, which you would expect, and illustrates the outperformance of equities and bonds. This is the comment on the 3-month property returns, and really what you see here, the pattern to draw out is about 2/3 of the way across you get to 2020, and you see what happened in terms of capital returns over the early part of the pandemic, and then the rebound and recovery in the market, which was really pent up, because if you go further back to say 2017, 2018, returns in commercial property were relatively lukewarm. Part of that was driven by some of the uncertainties around Brexit and previously the referendum. And just as the market was about to start moving forward, we had COVID. And then I think what I would say about 2021 was that you probably saw 2 years of performance within 1 year, because 2020 had been skewed by one particular event. And finally, really, this summarizes some of the performance of the sectors. And my final comment really would be in terms of investing in real estate. It's never been more complicated, certainly for generalist investors. If you go back to the global financial crisis, all real estate sectors on a total returns basis performed within about 1 or 2% of each other. So you can have an update like this. I can give you some of the detail on the nuances, but there was a peace of mind, a reassurance that whatever the weightings, whatever the strategy, the market would move broadly in line with each other. But that couldn't be further from the truth, not just between sectors, but within sectors as well. And to illustrate that, certainly look at the left-hand side of the chart, and you look at retail. The total returns for retail of over 30% at a market level is quite extraordinary. We saw our retail warehouses perform broadly in line with that. Some of it was recovery from the outward movements in 2018 and 2019, which the market was in a more challenging position and being rebased. But again, I think it speaks to the strengths and underlying fundamentals of retail warehousing versus, say, shopping centres and some of high street, which are still going through some structural changes. So I won't talk too much on this, but that's hopefully it illustrates that point. Oh, there is one more slide, and this is income return. And really, this is the comment about the arbitrage between commercial property and gilts. The long-term headroom between gilts, which is generally accepted as the risk-free rate, and commercial property has always trended around the kind of 250 basis points. It doesn't stay there for long, and certainly hasn't been the case over the last 10 years, where really property has had a bit of a free run against gilts. And you'll see this chart, if you go all the way to the right hand side, it's a little bit out of date, but you can see that headroom has been eroded. And where we sit today in terms of property values and 10-year gilts is broadly in line with the long-term arbitrage between those two measures. So that brings me quite neatly onto probably our discussion in the Q&A about the market going forward. Okay.
Matthew, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just using the Q&A tab situated in the top right-hand corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. We received a number of questions, both pre-submitted and live, and thank you to all the investors for submitting those. Christine, perhaps I could hand over to you to read those questions out to Matthew, and I'll pick up from you at the end. Hi, Christine. We can't hear you currently. What I'll do is I'll read out the first pre-submitted question while, Christine, if you could just reconnect your headset. What is your policy for new acquisitions?
Absolutely, and thank you for that. I think I've talked about the strategy in terms of target sectors and what we're looking at. So hopefully that's already covered. In terms of timing and what we'd look for, we're in a funny, difficult. So it's not funny, but it's a tricky stage in the market in terms of what's happening at the moment. When you experience markets where there's dislocation, that does present opportunity, and we've got a little bit of cash within the fund to invest. And the way we see it is we're long-term investors. So if we see mispricing, we see value, and we're underwriting potential opportunities with really robust assumptions, conservative assumptions, but we look at those assets on a long-term basis, which we think will deliver outperformance of the fund, then we'd certainly consider an acquisition in the near future. No, we have to be cognizant of the fact that values are under pressure. If you look at, I've got to be careful what I say because obviously there's confidential information. But what I can say is, if you look at most forecasters, real estate forecasters, they're expecting valuation movements of between, typically, very broadly speaking, 10 to 15% from peak to trough. I don't think that's unwise. So we're in that part of the market now. You can see the MSCI monthly movements went down in July and August. So we've got to consider that if we're looking at acquisitions. But there may be some distress, there may be some opportunities, and that's something that we'll consider in the near term as and when we see it.
Great, and I hope you can hear me now. Yeah,
you're back.
Well, good.
Yeah.
Oh, phew. Thank God for that. Yeah, we've had some really good questions. So I want to focus on the ones that seem to be not covered already, in your very comprehensive presentation. So one thing is buybacks. If you could outline for the audience a bit more detail about the plan there, what's commenced already, because this is quite new for the trust in recent times, and we have had a very detailed comment about it. So I just want to acknowledge that for the person who's listening, who provided that pre-submitted comment, and we take that on board. But for everybody's benefit, would you be able to outline in a bit more detail the buyback program?
Yeah, absolutely. So this isn't the first time that we've run at a significant discount. We're in the pack, as it were, in terms of the wider REIT universe, not just within the diversified space, but some of the specialist funds as well. But what's different this time? Well, we have liquidity. Again, going back to the sale of Berkeley Street, we have the option for share buybacks. In terms of the program, we just bought so far a little over 5 million of shares. In terms of where that goes, I mean, we don't know. It's constantly in review. It's monitored on a daily, if not weekly basis, and that's something that we'll, the board are staying quite close to. Obviously, we've got further cash, so there is the option there if we want to continue that program. We're cognizant of the fact that there's no direct science in terms of the impact of share buybacks. We want to speak to what we see, our beliefs about the fund, and the fact that we think the discount is overstated, even taking into account the pressures in the market. But the impact in terms of discount, well, it's very grey, if not gone completely, because obviously we've got the economic headwinds which we're facing, which is really since we started that program just about a month ago, or just over a month ago, it's the market has changed a bit since then. So it's very difficult, even more difficult to see what the impact is. But it's something that's it's something which is constantly in review.
Great, thank you for that. Another is about dividends. So somebody has commented before the presentation about the reduction of dividends a year or two back, and asking if that is going to be reinstated.
Yeah, certainly. So we're back up to 80% of where we were pre-pandemic. So that's 4p per annum. If you take the average, and it was 5p per annum before, that again, that's something which is in review. We're more than 100% covered at the moment. We do have a very strong reversionary potential within the portfolio. I mentioned industrial, but as a portfolio overall, we're in the kind of mid-teens in terms of the reversionary potential as an average, and we have lease events coming up which will support that. We've also got the rotation strategy, which we'll look to implement in the near term, where we see the opportunity. So there will be chances to move income on. We've got decisions to make in terms of uncovered dividends, and what our shareholder base would appreciate. We haven't made any decisions on that, but it's constantly in review. But it's certainly in the short to medium term, there'll be opportunities to consider moving that forward.
Yeah, and we'd welcome comments about that afterwards when the presentation finishes, if people want to comment on whether they're comfortable with uncovered dividends or not. Now, Jamie has asked about the structure of the debt in terms of fixed versus floating, and when it might need refinancing, given rocketing short rates and gilt yields recently.
Yeah, sure. So we're relatively well placed. So our main facility is with Canada Life, and that matures in November 2026. So we've got 4 years there. The rate is fixed. There's no floating element to that, and that's about 3.4%. We do have a rolling credit facility with Barclays. It's a £20 million facility. I commented on this in the presentation. We had drawn down about 7 of that. But the aspiration is to pay that off with the cash we have now. That's something which is in process. There is an element of that which is pegged to SONIA. So our overall cost of debt was lower than the 3.4, but would be higher now, obviously, with the rolling credit facility. But we'll be looking to remove that in the short term, and with no immediate plans to use that credit facility in the short to medium term. So the overall LTV is just over 22%, and it will be decreasing shortly.
Great, thanks. Nicholas has asked what level of lease break/expiries are due over the next 12 months, and what are you seeing with tenants' behaviour or expectations from these sites? Yeah,
certainly. So I think we've got about, in the next year, we've got about 15% roughly, give or take, of breaks or expiries coming up. Tenant activity, I mean, we haven't seen, in terms of the current conditions, we haven't had any tenants coming to us saying that they're in trouble or they need a rent reduction or anything like that. In the main, there are very few upcoming voids that we'd be sort of concerned about. A good example would be we've got the scheme in Bracknell. I talked about one of the units of the industrial scheme in Bracknell. It's a 2-unit scheme. The other unit is occupied by Panther Logistics, and they served notice because they outgrew the unit. They needed a bigger facility, which speaks to what's happening in logistics space still, the long-term megatrend. But we're under offer as it stands with another logistics occupier. That Panther lease expires next week, and we've just about agreed heads of terms with another occupier to take that space at a rent which is at a premium to our ERVs, and with very little capex required from us. I think the tenant is going to make some improvements there. So I think that's what we're seeing. As I say, on the retail warehousing, there are no expected upcoming voids, and elsewhere as well, we've got a industrial unit which the lease expires at the end of 2023, and we've had the occupier come to us. They actually initiated the discussions a little ahead of when you would normally start these, expressing an interest in a reversionary lease, and the driver for them is the fact that there are no alternate local options for them. They want to continue in that unit. They do have one eye on the rents as well. They'd probably like to secure the rents because they know they're going to move up, so it helps with their planning. But national occupancy, or sorry, national vacancy in industrial is depending on who you believe, it's somewhere between 2% and 3%. It's at an all-time low. Take up in the industrial space was 68% above long-term average in the first half of 2022. And some of these rents as well, I think we regardless of the current economic pressures, we always expected capital value growth in industrial to slow, because it had to. You couldn't keep seeing 25 bips come off your yields every single quarter, and there was definitely some overheating in that space. But those yields were based on some really meaningful percentage rental growth rates. If you go from £5 to £6 a square foot, that's a 20% uplift. That's quite considerable, and we're seeing locations going from 5, 6, 7, 8. And the reason they're going up so high is because basically the industrial space had a big affordability headroom. It kept you only really move rental growth on when you have supply demand tension, and we didn't have that in that sector. It kind of just missed its mark on each of the cycles, and really this only started in 2014, 2015. This trajectory. So that's why you've got this affordability headroom, and that's why you've seen such remarkable growth in that sector. And even if growth is to slow going forward, as I say, you've got quite a lot of growth in your already existing estimated rental values. So no, we're seeing, generally, going back to the question, I know I went off on a tangent, but going back to the question, we're going into this market with quite robust occupational markets, and as I say, we focused very much on strong occupiers in our offices, and same for industrial and retail warehousing, but looking at sustainability of businesses and essential retail and supply chain. It's all been something that we've positioned the fund for.
Super. Maybe we have time for just one more. Guy has asked a couple of questions, and one which I think is pertinent to most people listening. He's asking about the discount and why potentially CT Property Trust's discount is wider than some in the peer group and had been kind of singled out previously. Maybe even I can just say a couple of words, because obviously sales and marketing and trying to drive the demand of shares in the trust is core to our purpose and efforts. And so what I might admit is the fact that maybe over the last say 6 to 9 months, the messaging had got lost, especially with the fact that Columbia Threadneedle was then becoming the parent. Then there was then the change of fund manager, and so people didn't really see the differentiation as clear between this and one of our other physical commercial property trusts in our range. So as you can see now, though, we are making a big effort and drive to get Matthew more market presence and seeing more investors, especially in the wealth management space, seeing them face to face now that we can do that after COVID restrictions have eased, and we are putting a lot of budget behind marketing of this trust. But maybe Matthew, you'd be able to comment as well from your perspective.
Yeah, certainly. So I think as it stands today, we're I said earlier, we're in the mix. I think there's about 6 or 7 diversified trusts, out of the say 12 which are of discounts similar, if not slightly higher to ours. And that was the case if you went back to the spring as well. If you went back to April, and really, as Christine highlighted, it moved out over the summer, and we were marketing this fund really with an arm tied behind our back. Peter had handed in his notice, so a lot of investors were less interested in seeing the outgoing manager, not because it was Peter who did an excellent job, but because they knew he was off. And I essentially couldn't do anything formal on the fund until the 19th of July. I had to essentially serve notice on part of my job, which was one half of my job, which was formally deputy fund manager on BCPT, and that fund has its own challenges and shareholders to speak to, etc. So when it was announced and the position was announced, I still had to wait 3 months. So I don't think that helped particularly. Yeah, I think that summarizes there. I think in terms of the reaction to the, when you see discount in equities, there does tend to be an overreaction. I think the last 6 or 7 years has been extraordinary in terms of geopolitical changes, the referendum, COVID. There's been so many sort of micro cycles, if you will, and commercial property. And I think it speaks to the uncertainties. It's never been harder to get your head around. It's an asset class which has always been quite complicated and seen as higher risk, and it does have those characteristics, but it's highly nuanced. And when I have catch ups with shareholders in my old seat or in my new role, it hasn't been a catch up necessarily to just provide views on the market and what's happening in the portfolio. It's really to get under the bonnet and dissect what is happening out there, because it's very hard to understand without a deep dive, and that's been a theme of conversations over the last few years. So I can see why diversified funds, the discount has moved out to levels which we think are overstated, but we've got to be cognizant of the vagaries of equities.
Matthew, Christine, thank you very much for that. I think you've addressed those questions you can from investors, and of course the company will review all questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which I know is particularly important to you both, Matthew, could I just ask you for a few closing comments?
Yeah, certainly. So first of all, thanks. I talked for much longer than I was expecting, so apologies for that. But thank you if you're still on. Thank you for bearing with me. I'd like to just really highlight the performance of the fund. We're going through challenging times at the moment. I'd like to highlight the fact that this is a portfolio which has consistently delivered short and long-term outperformance against the index, and the qualities and investment ethos of the sector focus, the investment agility, the resilient locations, and the attractive income is something which has put the company in good stead in the long term, and it's something that I think we can play to its strengths in the immediate terms as I get my feet under the table with the portfolio. So that's all I'd like to say, except for thank you for staying on the line and giving me the opportunity to discuss the fund this morning.
Matthew, thanks once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of CT Property Trust Limited, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.